I want you to imagine a country that broke every rule of economics, a country that borrowed more money than any government in the history of civilization, not in raw dollars, in proportion to its own economy, 255% debt to GDP. Think about what that means for a second. If you earn $50,000 a year and you owe $127,000 on your credit card, that's Japan, and the payments on that debt keep growing every single year for 30 years. Now here's what every textbook said would happen. Collapse, hyperinflation, a currency crisis so severe it would shake the entire global financial system. Here's what actually happened. Nothing. No collapse, no hyperinflation, no emergency bailout from the IMF. Japan just kept going. And right now, at this exact moment, the United States government is looking at Japan and quietly taking notes, because America's debt just crossed $36 trillion. And someone in Washington has to figure out what comes next. So today we're going to answer 3 questions. How did Japan actually survive? What did it cost? And is America about to pay the same price? Stay with me, because what I'm about to show you will change how you read every single economic headline for the rest of your life. To understand where Japan is now, you need to understand what happened in 1991. Because in 1991, Japan was the most celebrated economy on the planet. Japanese companies owned Rockefeller Center in New York. They owned Pebble Beach Golf Course in California. Sony had just bought Columbia Pictures. At the peak of the bubble, the land under the Imperial Palace in Tokyo, a single piece of real estate, was worth more than the entire state of California. Let that number sit with you for a moment. One plot of land, worth more than California. Then the bubble popped. The Tokyo stock market fell 80% between 1989 and 1992. 80%. That's not a correction, that's a wipeout. Property prices fell 70% over the following decade. Banks were holding trillions of yen in loans that would never be repaid. Companies that should have gone bankrupt were kept alive by their banks. Economists called them zombie companies, consuming resources, employing people, producing nothing of real value. The whole economy had turned into a zombie, and the Japanese government faced a choice that every government faces after a crash. Option 1. Let it burn. Accept the pain now. Force bankruptcies, clear bad debts, rebuild on a clean foundation. Painful for 3 years, but honest. Option 2. Borrow, spend, stimulate, keep the lights on, keep employment numbers acceptable, keep the political cost manageable, and hand the bill to the next generation. Japan chose option 2. They built highways to towns that were already shrinking. They constructed bridges between islands that had no traffic. They funded infrastructure projects with no economic return, in regions with no economic future. Every time growth slowed, they borrowed more. Every time the economy shrank, they spent more. The debt started climbing. 60% of GDP, then 80, then 100, then 150, then 200, then 255. And every year, every single year, some analyst, some economist, some bank put out a report saying, Japan is going to implode. This is the breaking point. This time it's different. And every year, Japan did not implode. Which raises the only question that matters: why? Japan didn't survive by accident. It didn't survive because of luck or culture or some magic ingredient in Japanese economic thinking. It survived because of 3 very specific, very deliberate mechanisms. And here's what should make you uncomfortable. All 3 of those mechanisms are now operating in the United States. Trick number 1. Own your own debt. In most countries, government bonds, the IOUs the government sells when it borrows money, are held by a mix of domestic and foreign investors. When foreign investors hold your debt, they have power over you. If they decide your country is too risky, they sell your bonds. Bond prices fall, interest rates spike. Suddenly your government can't afford to pay its bills. That's a currency crisis. That's Greece in 2010. That's Argentina in 2001. Japan found a way around this. Today, more than 90% of Japanese government debt is held domestically. Japanese banks, Japanese insurance companies, Japanese pension funds, and most importantly, the Bank of Japan itself. The Bank of Japan, Japan's central bank, now owns more than half of all Japanese government bonds in existence. Read that sentence again. The government's own central bank owns more than half of the government's own debt. How did it buy those bonds? By printing money. The Bank of Japan created yen out of nothing, used those yen to buy government bonds, and called it monetary policy. When you owe money to yourself, when you can literally print the currency your debt is denominated in, you can never technically default. You can always print more money to pay the bill. The United States Federal Reserve did the exact same thing starting in 2008. They called it quantitative easing. Between 2008 and 2022, the Fed bought over $7 trillion worth of government and mortgage bonds using money it created electronically. Japan just did it first and went further. Here's something most people don't understand about debt. The danger of debt is not how much you owe. The danger is how much you pay every year just to hold it. Think about a mortgage. If you borrow $500,000 at 2% interest, your monthly payment is manageable. If the rate jumps to 8%, that same debt becomes crushing. The same principle applies to governments. At a certain interest rate, any level of debt becomes unmanageable. Japan understood this, so Japan kept interest rates near zero for over 2 decades. Not just low, near zero. At points actually negative, meaning banks were paying the government to hold their money. At 0.1% interest on 255% debt to GDP, the annual interest payment is manageable, roughly 2.5% of GDP. At 5% interest on 255% debt to GDP, the annual interest payment would be 12.75% of GDP. That's more than Japan's entire defense budget, education budget, and social services combined. The government would collapse. So Japan couldn't let rates rise. Wouldn't. And to make sure they didn't, the Bank of Japan introduced something called yield curve control. Yield curve control means the central bank sets a hard ceiling on interest rates. If rates try to rise above that ceiling, the Bank of Japan steps in and buys unlimited bonds until rates come back down. It is, in the most literal sense, the government controlling the price of money. The United States hasn't formally adopted yield curve control yet, but watch what happens every time the Federal Reserve even hints at cutting interest rates. The Treasury Secretary appears, the President comments. Market analysts talk about debt sustainability. The pressure to keep rates low is structural. It's built into the debt itself. America already pays over $1 trillion a year in interest on its national debt. If rates stay elevated, that number goes higher and higher until something breaks. This is the one nobody talks about at dinner parties, but it might be the most important. Here's the hidden engine of inflation: expectations. When workers expect prices to rise, they demand higher wages. When companies expect wages to rise, they raise prices preemptively. When everyone expects inflation, you get inflation, even if the underlying conditions don't fully justify it. It's a self-fulfilling prophecy, and it's the central bank's worst nightmare. Japan found a way to break the cycle, not by fixing the underlying problems, but by convincing everyone that prices would stay flat forever, and it worked. For 30 years, Japanese consumers expected deflation. Prices would fall, not rise. So they waited, they saved, they didn't demand higher wages. They accepted flat salaries because they believed flat prices were permanent. Economists call this anchoring deflation expectations. What it actually meant for ordinary Japanese workers was 30 years of salary stagnation disguised as stability. The trick worked because Japan suppressed demand. Less spending, less consumption. Less economic pressure on prices. Economists have a polite name for this outcome. They call it managed stagnation. You might recognize it by a different name. It's the feeling that no matter how hard you work, no matter how many hours you put in, you can't seem to get ahead. The math just doesn't add up. That feeling is not an accident. It is a policy. Here is the part of the Japan story that almost never makes it into the headlines. Japan avoided a crash. That's true. But it did not avoid the pain. It converted a 3-year crisis into a 30-year slow bleed. The bill didn't disappear. It just got distributed across an entire generation in tiny, invisible increments. Let's talk about the people who paid it. In Japan, the generation that entered the workforce between 1993 and 2005 is called the lost generation. These are people who graduated during the stagnation, when companies had frozen hiring, when lifetime employment, the cornerstone of Japanese corporate culture, had quietly ended. Millions of young Japanese workers took temp jobs, part-time contracts, unstable work with no benefits and no career path. Not because they were lazy or unqualified, because the economy had no room for them. Many of them never recovered. Today, members of Japan's lost generation are in their 40s and 50s. They never got the promotions, never built the savings, never bought the house. Japan's marriage rate collapsed, its birth rate followed. Today Japan sells more adult diapers than baby diapers, more pet food than infant formula. An entire civilization quietly deciding not to reproduce, because the economic math of raising children simply didn't work. Now, look at the numbers. Real wages in Japan today are lower than they were in 1997, not adjusted for some obscure index. In actual purchasing power, Japanese workers today can buy less with their salary than their parents could buy in the late 90s. The Nikkei, Japan's main stock index, peaked in December 1989 at 38,915 points. It didn't return to that level until 2024, 35 years. If you invested your savings in Japanese stocks at the worst possible moment, at the peak of the bubble, you spent 35 years just getting back to where you started, not growing your wealth, just recovering it. Think about what that means for retirement, for college funds, for the dreams people build on the assumption that working hard and investing carefully will move them forward. Japan's managed stagnation didn't look like a catastrophe from the outside. There was no moment of crisis, no televised collapse, no breadlines. But inside the society, a slow erosion happened. Opportunity shrank. Ambition recalibrated downward. The future got smaller. That is the true cost of the Japan model, not a crash. A quiet, persistent, generational compression of human potential. Now let's bring this home. I want to walk you through a list. As I read it, I want you to tell me, is this Japan or is this the United States? After a major financial crisis, the central bank cuts interest rates to near zero and holds them there for years. The central bank begins buying government bonds with newly created money, on a scale never seen before in peacetime. The government runs trillion-dollar deficits for years in a row, with no credible plan to return to balance. Political leaders from both parties agree on one thing: don't cut spending now, we'll deal with it later. The central bank's balance sheet, the amount of assets it holds, expands to levels that would have been unimaginable 10 years earlier. Interest payments on the national debt grow so large they start crowding out other government spending. The answer is both. After 2008, the Federal Reserve cut rates to near zero and kept them there until 2015. Then, after COVID, they went back to zero again and held them until 2022. In 4 months in 2020, the Fed printed $4 trillion. $4 trillion in 4 months. To put that in perspective, the entire US GDP is around $27 trillion. The Fed created the equivalent of 15% of GDP in 120 days. When the Fed finally had to raise rates in 2022, because inflation got out of control, it triggered exactly the crisis Japan had been avoiding for 30 years. At higher interest rates, the US annual interest payment on its national debt crossed $1 trillion. $1 trillion a year, just in interest, not paying down the debt, not building anything, just servicing the existing balance. That's more than the Pentagon budget, more than Medicare, more than Medicaid. And every year, the debt goes up. Every year, the interest payment goes up. Every year, there are fewer options. The Federal Reserve now holds over $7 trillion in assets. Bonds it bought with printed money. The Bank of Japan holds $5 trillion in an economy 1/3 the size. Both central banks have now bought so many of their own government's bonds that unwinding those positions, selling the bonds back into the market, would trigger a collapse in bond prices and a spike in interest rates that neither government could afford. They built the cage together, and now they're both inside it. There is no clean exit. Now here's the part where the comparison gets more complicated and more important, because America and Japan are not the same country. And the differences matter. The first difference is savings. Japan's population saves aggressively. Japan's household savings rate historically runs at 10 to 15% of income. Japanese pension funds are massive. Japanese banks are loaded with domestic deposits. This matters because it means Japan has a domestic pool of capital that consistently buys government bonds. When the government issues new debt, there are always domestic buyers. America's personal savings rate is currently under 5%. Americans spend. American consumers are the engine of the global economy, but that engine runs on consumption, not savings. To fund its debt, the US depends heavily on foreign buyers. China, Japan, Saudi Arabia, the UK, foreign governments and investors who hold US Treasury bonds, because the dollar is the world's reserve currency, and those foreign buyers have been quietly reducing their holdings for the past decade. China's US Treasury holdings are at a 15-year low. Japan has been selling. Saudi Arabia has been diversifying. The second difference is cultural tolerance for stagnation. Japan is a high-trust, consensus-oriented society. When wages stayed flat for 30 years, there was social frustration, but not political explosion. People accepted the reality. They adapted, quietly. America is not that society. America is loud, politically fractured, and deeply sensitive to economic inequality. When ordinary Americans feel squeezed, when the cost of living rises faster than wages, it produces political upheaval, it produces populism, it produces instability. The Japan model requires a population willing to absorb economic pain without demanding political change. That is not America's default setting. The third difference, and this is the biggest one, is the dollar. The US dollar is the world's reserve currency. Roughly 60% of global foreign exchange reserves are held in dollars. International oil contracts are priced in dollars. When countries trade with each other, they often settle in dollars. This gives America an extraordinary privilege. It means there is always global demand for dollars, which means there is always global demand for dollar-denominated assets, which means there is always demand for US Treasury bonds. This privilege is the reason the US can run deficits that would bankrupt any other country. The world needs dollars. And to get dollars, the world buys treasury bonds. But this privilege is not permanent. It is not guaranteed. It is not written into any law. It is maintained by trust, by military power, by economic dominance, by inertia. And all four of those pillars have been under pressure. If reserve currency status erodes, even partially, the math changes completely, because suddenly, the global demand for treasury bonds shrinks, and the US can no longer run Japan-style deficits on Japan-style terms. Let's make this personal, because none of this matters unless you understand what it means for your actual financial life. If America follows the Japan path, and the current trajectory suggests it's heading there, here is what the next 15 to 20 years probably look like. First, interest rates will stay structurally low, or get pushed back down the moment debt payments become politically unbearable. Expect rates to drop again within the next economic downturn, regardless of inflation. Second, asset prices stay inflated. Stocks, real estate, bonds. When money is cheap, capital flows into assets. The people who own assets benefit. The people who don't are left behind. Third, real wages stay flat or grow slowly. Costs, rent, groceries, healthcare, education, rise faster than salaries. Every year, the gap between what you earn and what it costs to live a middle-class life gets a little wider. Fourth, cash loses value slowly, not in a dramatic crash. In a persistent 20-year drip, the money sitting in your savings account today buys a little less each year, not because of some crisis, just because of structural inflation that nobody in power has a political incentive to actually eliminate. Fifth, the gap between people who own productive assets and people who depend on wages gets wider. This has already been happening since 2008. The Japan model accelerates it. Now here's the critical question. What did the people who understood this do in Japan? The ones who lost the most were the ones who held cash and waited, who believed that things would return to normal, who trusted that the economy would reset and reward patience. It never reset, and their patience was not rewarded. The ones who preserved wealth were the ones who understood that in a managed stagnation, the system doesn't fix itself. It just redistributes, slowly, invisibly, from people holding cash to people holding assets. This is not financial advice. I'm not telling you what to buy or sell, but I'm telling you this. The first step to protecting yourself from a system is understanding how the system actually works. And now you do. Let's bring it all together. Japan built the most indebted government in modern history, and it didn't collapse. It survived by doing three things: owning its own debt, keeping interest rates near zero forever, and suppressing expectations so thoroughly that an entire generation accepted flat wages as normal. It avoided a crash. It did something arguably worse. It traded a 3-year crisis for a 30-year slow erosion of human opportunity. No dramatic failure, no moment of reckoning. Just a quiet, relentless compression of wages, prospects, and futures, spread across 30 million working people who never saw it coming. America is now writing the same story. Bigger numbers, different culture. A currency that still carries the weight of the world. For now, whether the ending is the same, we don't know yet. But the chapter we're in right now, you've seen it before. It was written in Tokyo, starting in 1991. Now you know what to look for. Every time the Fed hints at cutting rates, you know why. Every time a politician says we can manage the debt, you know what managed costs. Every time someone tells you the economy is fine, you know what fine looks like from the inside. If this video showed you something you didn't see before, hit that subscribe button right now, because next week we're going even deeper into the machine. I'll see you there.